Hi everyone, how are you today? How are you doing? Another live stream, okay, basically with another live stream with no agenda. I don't have any, plan of what I'm gonna talk about today other than probably the last stock that one of my last buys that I made not long time ago. It's a company that probably most of you already know about, even if you follow me on Instagram, probably already know about this stock because um, I kind of mentioned it a lot. I mentioned it a lot. I talked about it a lot, and I teased about it. And I said that I'm running, on my Substack about it. So basically, you should have already known. Oh my God! Did you see this guy? What a joke! So basically, this guy he laid off employees and then he posted himself crying. I mean, I don't know if it's genuine, but it just uh, it just went viral and everyone is like, talking about it. Argentina hikes interest rates by 950 basis points to 69.5% as inflation hits 20-year high. Jesus Christ. They hiked interest rate by 9.5%. Central bank raised rate for the 28-day term to 69.5% from 60%, a rate that banks set just 2 weeks ago when it hiked the rates by 800 basis points, and the government shuffled its cabinet to install a new economy super minister. By the way, if I'm not wrong, there was a sovereign bond by Argentina not long time ago that was actually sold. Yeah, I think I'm right. Let me check it out. And people were criticizing it, saying like, what's different right now? Why should because Argentina is known for like its economic problems. Let me see, Argentina bonds or new bonds issuance. Let's say. Yep. Let's see. Yeah, I think this one. Yeah. Well, I'm not quite sure, but I do remember that there was some story about them actually issuing debt, for the country, basically, and people were actually saying, like if Argentina keeps on falling all the time and there's a lot of economic problems, why would people invest in it or be the debt holders? And basically, people actually went and bought some, and yeah. So this is crazy. Let's see what else in the news. Here's where China real estate trouble could spill over. By the way, this is okay. So this is an article on CNBC. Okay, as you can see over here, an article on on CNBC about Chinese real estate trouble. Okay, and on the Wall Street Journal, you have the same thing. The bursting Chinese housing bubble compounds Beijing's economic woes. So we have both CNBC and the Wall Street Journal actually talking about the Chinese real estate bubble, and it's like funny that like once they want to push something that you'll know about it. Like this thing has been going on for a long time now, but now they want to push it, and you will see it probably everywhere. The next news outlets or news websites would be probably Reuters or whatever, but it's gonna be the same the whole time. Impact on other sectors. Well, China is the second largest economy in the world. For all the people are cheering for China to fall, and let's say you're from the U.S. It's not something you want to wish for. You know, the whole world economy is like a giant spider web. The whole thing is like a giant spider web, and if you poke one side of the huge spider web, then you're gonna you're gonna have vibrations sent to the other side. And if this the whole global economy is basically connected right now, and every single tweak or every single touch would literally send you know, if we're talking spider web, it sends vibrations to the whole structure. And you know, like, the most recent example we can actually talk about is basically China. It's basically Russia and and Ukraine. So everything is connected. Nothing is like standing alone and not connected. Everything is interconnected. Whether it's China, whether it's Ukraine, whether it's Russia, whether it's the United States, the whole thing is like a giant spider web. The whole globalization actually made us very connected to the good and to the bad, you know. And yeah, so also, if you wanna like cheer for China to fall, it's not a good idea, because we're gonna get screwed too. By the way, if you want 4 stocks to short, Jim Cramer basically came out with his 4 picks. Unfortunately, by the way, his top picks, some of them are my holdings. So here are his stock picks. He picked Amazon, AMD, Microsoft, and Disney. So it's bad for me. Why? Because I hold Disney. It's my largest position. Amazon is my second largest position, and Microsoft is also one of my positions. So basically, you know, my portfolio is gonna be doing bad probably soon. If Jim Cramer picked Disney, Microsoft, and Amazon, and these are 3 of them are my positions, oh my god. I hope you know I'm gonna be lucky this time, and he's not gonna. Oh, and look, my name is here too. So I guess it's like a sign for me from God, probably. I don't know. Tamer. Okay, my name is Tamer, by the way, for those who don't know. Like, it's Tamer, but I mean, you know, everyone calls me Tamer. So yeah, inflation is not yet tame, but it's tamer. And tame inflation can bring the old pattern of the market tumbling the day after any rally, he said. That didn't happen this time, and you can feel confidence oozing back, he added. Oh my god, this is bad. Yeah, but, you know, all jokes aside, right? Disney is in a great shape. Okay, they reported earnings, and the stock literally went up by probably 10% within, like, in 2 days matter. That the first 4%, I think, was after the CPI report, which is the inflation report. We're gonna talk about it if you want. And the second 5 or 4.5% rise was after the reported earnings. And the reported earnings basically showed us holders that the parks are doing very good. And I had some, like, you know, I was thinking about and worrying about the whole streaming segment of Disney. Not because it's not strong, not because they don't have content. They have a lot of content. And I actually believe that at some point, they're going to be one of the most major players in the streaming world, if not the best one, even. This is part of my thesis, by the way, why I bet on Disney. But, you know, the CEO basically had a very aggressive target, where he said that they're going to reach between 230 million to 260 million by 2024, plus they're going to reach profitability too, meaning that the segment will start bringing money to Disney, and they're going to get to 230 or 260 million subscribers on Disney Plus alone. So to me, that was an issue. Why? Because looking at different platforms, all of them basically said that subscribers basically either the growth either fell, or some, like Netflix basically, had subscribers leave the platform. And then you see Disney over here saying that they're gonna get to 230, 260 million by 2024, when the whole industry was plateauing. But they beat on expectations. They basically brought in more subscribers than was estimated. But they say, but also the CEO, which kind of like, fulfilled my, let's say answered the worries that I had, and everyone else, by the way, had. Like, if you go on Wall Street Journal, you can read this. If you go on CNBC, it's not like I'm a genius. Like, everyone was saying that he might go out and basically say that we need to like bring down the expectations of the subscribers for 2024 or 2025. I don't know exactly when. I think 2024. I'm not sure, but it doesn't matter. He said that within the next couple of years, they're gonna reach 230, 260 million, and they basically lowered the expectations right now. They're lucky. In my opinion, they're lucky, especially in this market. They did very well in the recent quarter. They did very well. The parks did very well. Everything, all the segments went actually very good. And why I'm saying they're lucky, because we see how companies are getting punished recently when they miss earnings, or when they miss something on estimates. So Disney beat both on revenue and on net income. So they didn't miss on anything. But the only thing they missed on was the growth segment that is expected to grow for years ahead, which is the streaming segment. And they lowered also. I mean, they lowered expectations. Didn't miss on it. They lowered expectations, and the market recently is not like this, cute market where back then, if a company used to miss or basically lower expectations, nothing would happen. No, this market is punishing all of the companies. We saw it with Facebook 2-3 quarters ago. We saw it with Netflix. We're seeing it with big companies too. It's not like small companies that have small market cap. They are big companies. They're companies that have a lot of big market cap. And they can basically take the whole market down if they fall. Another company that I own, which Kramer is bullish on right now, unfortunately, is Amazon. And again, Amazon is also a strong company. They also reported the earnings, and basically they're doing also fine. Microsoft is one of my favorite stocks. Microsoft is a stock that I've been holding for years now, and I'm not gonna sell it. I basically bought it when it was $64 a share, and I bought shares for myself, and I bought one share for my youngest brother. I told him, this is gonna be your gift for your graduation. And after 3 years, I guess it was, he could have sold it for $100 and something, if I'm not mistaken. And that was his gift. The one share that I bought him, he took it, and he didn't sell it actually. I gave him the money, and I kept the share. But he wanted the money. That was his gift. So I just kept the share and I gave him the money, and it was his share basically. But I just bought it from my account. So I told him that I'm gonna like buy for me, and one of the shares that I bought is gonna be yours. And once you finish your graduation, once you graduate, I'm gonna give you this one share. And he decided to take money. So I gave him the money and I kept the share of Microsoft. And the point is, with Microsoft, I don't think I will ever get out of close the position in Microsoft. Not because I'm attached to the company emotionally. It's not that at all. I'm not at all attached to the company emotionally. It is the fact that there's a CEO over there that he knows what he's doing. He's a very good CEO. The company has recurring revenue. The cloud is growing. They're the only one who's competing with Amazon right now on the same scale, and they keep growing. So it's not like they're slowing down in terms of the cloud. They're not. Honestly, it's one of the best businesses out there. AMD, I don't know a lot about AMD. I'm not gonna talk about it. I really don't know a lot about AMD, so I would leave it to the people who actually know about it and can actually add some value about AMD. So to me, I'm not gonna say anything about AMD. I don't know anything about AMD. So let's talk about Jim Cramer's giving me fever. Let's talk about the company I that I bought not long time ago. So the company that I bought not long time ago is Levi. Okay, Levi's is a very boring company, and boring companies are my favorite companies. The reason for that is because when you invest in a boring company, there's no big surprises. And if there's a big surprise, then after all, we're in the stock market, there's risk in everything, and we have to be adults and say, well, we might have missed something. So Levi's is a company that basically sells jeans. Okay, that's what they do. They sell clothes. Mainly they sell jeans. Levi's have 5 main brands. Okay, the first one is Levi's. The second one is Signature by Levi Strauss & Co. The third one is Dockers. The fourth one is Denizen Brands. And the fifth one, which they acquired back in 2021, is Beyond Yoga. Now, if we take a look at Levi's revenue share, I will show you the revenue share. I will put it over here. We can see that 87% of their revenues comes from the Levi's brand, which is the jeans and the clothing and stuff like this. Okay, and then you have these two brands, Signature by Levi Strauss and Denizen. They account for only 8%, and then you have Dockers and Beyond Yoga, they account for 5%. Okay, so if you have some belief that in the future people are not gonna wear jeans or people are gonna stop wearing jeans, then do not buy Levi's. That's not a company that you wanna buy. Now the beauty of Levi's is that they already, that's like a thing that probably gives me some comfort, but also it's kind of like a headwind, not a headwind, it's kind of like a limiting factor, let's call it that way. So the company's products are already being sold in 110 countries around the world. Okay, so basically they expand everywhere. Okay, they expand everywhere, and the expansion is not, they're not gonna expand more, like the only thing that's gonna happen right now is basically they need to make sure that they can raise prices, okay, and they need to make sure that people are gonna come back and buy their stuff. This is the only thing that they need to make sure about. With that being said, now we're seeing that it's easier for new companies to emerge and actually bite or take some market share from existing companies, even if it's Levi Strauss. Okay, so I'm gonna always be looking for the small company that's gonna come and gonna start biting and taking some market share from Levi's. How, I have no clue how it's gonna happen, but it happens every single time. It happens all the time. So when it happens, we're gonna see how they're gonna deal with it, and that basically it all boils down to the management. How are they gonna deal with it? Will they buy them out, the small company? Will they crush them? Will they make the same product and sell it for less? This is basically when it comes to the management. Like when you see Facebook, let's talk about Facebook for a second. Okay, Facebook now was having a lot of problems from TikTok. Okay, but Mark and also Cheryl, they are one of the most ruthless, in a good way. If you're a shareholder, you want the management to be, a management where they don't care about crushing their competition. I know it sounds like mean or something, but if they want to survive, they had to copy stories from Snapchat. If they wanted to survive, now they have to transform Instagram, where they have reels. This is the game, like, I know it doesn't sound like nice, but this is it. You want, let's say, Mark to shift the strategy of Instagram and make it where it kind of like close to TikTok, but not TikTok, because Instagram still has something special to it, in my opinion at least. I love Instagram. I have my page over there. I have my community over there. I love Instagram. Okay, and I can see, from as a creator, I can see how they're shifting, even the reach. Once I make a reel on Instagram, I have so many views. It just goes. Sometimes it even goes viral. I have thousands and thousands of views and even likes. Okay, but if I post like a normal, post, a picture, something static, not moving, I get 100, 150 likes, and I have 41,000 followers. It's not like I have 1,000 or 2,000. And back then, I used to get 800, 1,000 likes. So you can see how they're trying also to convince us, the creators, to go down that path where we have to create more videos, where we have to be more creative, and so this is what I mean when I say it all boils down to the management, how they shift their or how they shift their platform, how they make it where even I'm looking at the reels recently, and at the beginning I really thought it was boring. I really thought that reels were boring. It's just like a copy of TikTok, and it's not even a successful one. But now recently I'm going there and I'm seeing that people are actually being more creative. They're posting like some fun stuff, and I deleted TikTok. I don't need it anymore, because TikTok is, disclaimer, I am a shareholder of Facebook, of Meta. TikTok is like, okay, never mind. I'm not gonna even, because it's probably gonna some piss people off, but it doesn't matter. So go back to Levi's. This is what I mean when I talk about the management. You want someone who's able to steer the company in the right way and deal with competition. That's the most important thing. When you have a profitable company, competitors are gonna come and they're gonna take bite from they're gonna start, trying to get into your territory and basically getting into your products and even sell the same thing. So as I said, as I said about the growth. So the growth is somewhat limited. People need to go back and buy the same products at some point. I feel that people might be, like, just bored about it, and maybe something will come up, but I don't think something's gonna replace jeans. Another thing that I want to talk about is that the company is actually steering to build its online experience, the direct consumer push that they're making. So since 2011, the DTC, the direct to consumer segment, was only 20% of net revenues, and now is 40% of the company net revenues for 2021. Okay, the beauty of the thing over here is that this segment has better margins than the normal one. Okay, so they cut the third person, or they cut the middleman. Okay, and then you have higher margins for the company, and that increases net income. So that's, in my opinion, that's a good thing. Another thing that I like about this company is their financial discipline. So they have targets, and the targets that they have are not, they're not absurd. They're actually like okay target. They want to reach an EBIT margin of above 12%. Okay, like, it's not that hard to do that. Let me see what else. They want to return cash to shareholders by dividends and share buybacks. Like that's basically a good thing if because again this company needs to reduce its this the management needs to worry about three things. First, they need to worry about being able to raise prices, of course, in a normal fashion, not in a way that people are just gonna run away and not buy it anymore. They need to worry about staying trendy, that people will come back and buy their jeans or their other clothes. And the third thing is that they need to worry about bringing money back to shareholders. Okay, they will do it by two things. The first one is share buybacks, and the second thing is dividends. And I'm sure that the company can handle it. By the way, another important thing to look at when you're investing in Levi's is the price of cotton. Okay, so the fluctuation of cotton basically will determine the gross margins of the company, because the main material they use is cotton. Okay, so if you take a look at the chart, I put it over here. You can see that the price went crazy, right? But then it fell. I mean, and the expectation is that it will continue dropping. I don't know a lot about prices of commodities and what's gonna happen. I don't know. Okay, but I'm gonna keep an eye on it just to see before, let's say, earnings results, how the prices of cotton are doing. Are they going crazy? And that's basically where it ends to me when it comes to this thing. Again, I have no idea what's gonna happen to the price of cotton. Will it go down? Will it go up? Will it stay stable? I don't know. I'm not gonna lie. But I'm gonna keep an eye just in case, if anything goes crazy, so I just know what I'm doing. Let's talk about long-term plans. Okay, so Levi plans to grow revenues in the range of 6% to 8% annually. Okay, which, by the way, I will get to my valuation in a minute. I made the estimates on the lower end. I basically even made it lower than 6%. I will show you when I get there. Okay, they want to get to EBIT margin of 15%. EBIT is earnings before interest and tax. Okay, that's basically an indicator for the company's profitability. So they want to return also 55 to 65% of free cash flows to shareholders. So basically, that's an amazing thing that I just told you about a minute ago, that they need to worry about getting money back to shareholders. Okay, and they're gonna do it by stock share buybacks, and they're gonna do it by dividends. So basically, that's what we want. Okay, we want them to bring money to the shareholders, us, because again, the company doesn't have a lot of growth prospects in the future, and you need, in order to compensate for that, you need to give shareholders dividend, and you need to reduce the outstanding shares, and that's how you also increase earnings per share, right? So that's what we want. And like, some people are not fans of the whole buying back shares and everything, but you need to understand that this is a very well, let's say, practice when it's done in the right prices of, like, when a stock is falling, okay, the company should be aggressive and buy back its shares. That if they have enough liquidity and nothing has changed in terms of the business, okay. Unfortunately, when a stock falls like this, 50 or 60%, there's a reason for that, fall, for that drop. If we are in a bear market, as we are right now, and the stock falls like 30 or 40%, then it's it's a good thing, because then we could buy cheap, and then also the company could buy its shares for cheap, So this is one good financial engineering plan where even if the company, let's say, managed to grow its earning per share by 2 or 3%, and if they reduce their shares by 2%, let's say, a year, then the company grows its earning per share by 5%. Okay, so this is financial engineering, but everyone uses it, and it's not a bad thing. The US market is basically doing very well. Okay, the revenue last quarter grew 20% and reached $1.5 billion. And with that being said, the supply chain issues, limited growth by 2%. And what's good about this part is that, supply chain issues are easing, inflation is easing, and hopefully, it's going to be a tailwind for the company that all the prices of their materials dropping and supply chains will be even easier, the supply chain issues will be easier or resolved, and then the 2% of growth will be added to the normal growth of the company. So let's go to the valuation. I'm gonna talk about it like briefly. By the way, my valuation, the stuff that I do is very, very simple. Okay, I do not like to complicate anything, and I'll just go through it very fast. I will show you. Let me see if I can see like this. Okay, if I go like this. Let me see if you. So I want to make sure you guys see it. I think it's good enough. Yeah. So remember when I talked about the. Okay, let's do it like this. Let's go like this. Okay, so this table basically over here, I'm estimating how much revenue the company will bring by 2026. Okay, currently the revenue is $6.4 billion. Okay, so for 2021 the revenue is $5.76 billion. Okay, for 2022 the expectations are by analysts the expectations are that the company will bring in $6.4 billion. Okay, that's for 2022. Now, for 2023, 2024, 2025, 2026, I applied these growth rates, which is 5%, 6.5%, 6%, and 6.5% again. So if you remember, the company basically said that they expect future growth to be between 6% to 8%. Okay, I applied growth rates on the lower end of their expectations. Okay, why is that? Because I like being conservative, and especially when I'm gonna repeat this thing over and over again. When I make a research when I like analyze a stock and I post it to everyone, I like to be very, very conservative because I don't want anyone to get excited about a stock, buy it, and then, in the stock market anything could happen. And let's say the stock falls and they're gonna start saying, well, you said it's undervalued, you said this, you said. So, this is like the numbers that I put. You can apply more aggressive numbers, you can apply less aggressive numbers, you can do whatever you want. Okay, but when I post the research, it's very conservative, and I'm not aggressive when I do it like this, because I don't want anyone again to be excited and go all in or buy this. I don't want anyone to lose money because of me. So I'd rather be conservative and people, thinking twice before investing, rather than being someone who hypes a stock, gets people in, and then I don't know, something happens, as anything could happen to the stock market, and then the stock falls, and then they say, well, we relied on your research, and this is only for entertainment purposes, nothing else. And education, of course. I'm like, if you can get any value of this, then that's great. Regarding the EBITDA, regarding the EBITDA, I applied over here 13% margin. Basically, for 2021 they reached 15%, and if we take a look at historical EBITDA margins, we can see that the company was in the mid, they got to the 15. They got to the 15, and they got to the probably 14 over here. But again, conservative, the whole thing. I applied 13, stayed on the safe side. I applied discount rates of 9, 10, and 12%, and this is the free cash flows that I got for 2022 to 2026. Let me zoom out a little bit, I think it's too much. And then, I applied the 9%, the 10%, and the 12%. Then you get to the cash flows, the present value of the cash flows, the exit, 1.5 multiple. Long story short, this is what I got. I got that the per share price, let's say the intrinsic value, should be $23, $22, or $20, of course, according to the discount rates that I applied. And they're all, by the way, higher than what the stock is selling at right now. Basically, what I'm implying over here is that the stock is undervalued. And I was conservative again. I wasn't being too aggressive. But again, everything I'm saying over here is an opinion. You could ask someone, for example, to make the same research and do the same model. They would apply, of course, different numbers, and they would get to a very different results too. They might get to a result where it says that the fair price of the stock is $15 per share, which implies that the stock is overvalued. So anyone can do, when it comes to the models, you can play with the models, you can apply, you can just put numbers, and you would have very different results. Again, this is my opinion. It's not like a recommendation or anything. And disclaimer, I do own Levi stock. It was my I said actually that I bought it before, and So basically, this is it for today. I wish someone was watching that could ask them if they need anything to to ask, and I would answer the question. But basically, this is it. To those who's gonna watch the live stream, I hope you're gonna enjoy it. I hope I'm gonna add value to you. By the way, other live streams, I'm getting views on them. I got 75 views, 35 views, and which is great, because people are not connecting on the live stream, but they actually go over there and they go after and they watch it, which is good. This is it for today. Thank you for watching, and I hope at some point, I'm gonna keep on doing these live streams, and I hope at some point we're gonna have people actually interacting with me while I'm doing the live stream, and then it could be more fun. I could, of course, talk about stuff that interests you guys and not only what I want to talk about. And this is it. And I'm gonna publish the Levi's research right now. If you are a subscriber on Substack, you're gonna receive an email in your inbox of the research. If you're on my Instagram, then I'm gonna probably put it over there, and you can also click the link and get it from my Instagram. Thank you for watching, and have a great day.